All right, Maria, well, stocks are seeing some gains today on the heels of better than expected jobless claims numbers that Steve Leisman told us about earlier. Although we are off session highs, the markets are still in positive territory. Is there any strengthening in the U.S. economy that's going to affect the U.S. stock market? One of our next guests expects to see total returns of 8 to 10% for the S&P 500 next year. Which one of you said that? I'll find out in just a second. Let me introduce you our guests here. Joining us today, Mark Lamkin, CEO of Lamkin Wealth Management, along with Tom Lydon. He's from Global Trends Investments and ETFtrends.com. Who's the big bull here?
I'm the big bull right now. I think so. Yes, sir.
Well, what will propel that? I mean, we've been so focused on Europe, but we aren't even focusing on our own economic data these days, right?
I agree, Bill, but we're to the tipping point in Europe. It's going to get cleaned up. There's just trying to be some forced austerity. Once that happens, you're going to see some type of TARP or quantitative easing, and then it gets back to U.S. fundamentals. And based on valuations and record earnings in S&P 500, we will get back to those types of fundamentals, and we're going to get 8 to 10% next year if we get Europe kind of a quarantine package.
I feel like I'm doing talking numbers again because I got fundamentals versus technicals, because so many averages and investments are falling below that key 200-day moving average right now, Tom.
It's true. And yesterday when we lost gold and we lost oil, that list of safe havens just got that much shorter. So today, the average investor is just not engaged. You have to turn to yield. And with treasuries being so low, I think there's some areas, not just here domestically in corporate bonds, but also overseas in emerging market debt, we can get 4 and 5% where they have balance sheets that are much better shape than ours.
You know, sentiment is not great, obviously, right now.
Right.
That could work to your advantage as a contrary indicator, but it could also just be a current reflection of what's going on here. Is there something that could change your mind about our market right now?
You know, I think consumer sentiment, the daily tracking with Rasmussen continues to get better. The job picture's getting better. We're starting to get momentum. Just any positive news out of Europe. I'm 50% cash right now. I'll start putting that money back to work. And let's face it, my favorite sector's been beat to heck this week with technology. I'm ready to go back in, but when the technicals get better on it. So I'm still all about Europe right now and watching fundamentals.
And this could be a head fake, you know, these moves below the 200-day moving average. We haven't been there very long.
But, you know, if you follow that, you're not going to get hurt. So if you wait till it goes above the average and then buy at that point, use that point as your stop loss point, you're not going to go down 10, 20, 30%.
That's right.
So at this point in time, it requires a little bit more time, a little bit more patience, a little bit more discipline. But the big thing right now, it's all about risk and not getting hurt.
Were you disappointed the Fed didn't do anything when it met on Tuesday?
I'm not. I think the Fed got it exactly right. They've got to communicate right now. They can't use all the arrows in their quiver, and they want to make sure that Washington starts doing something. At a 9% approval rating, they have to do something different. And if they don't, then and only then you'll see the Fed act. So I think the Fed got it right this time.
And, you know, thinking about what he is saying here, the long-term investor is going to position themselves for that long-term, expecting that things will get better at some point. You could miss a move if you start worrying about these short-term indicators right now.
You sure could. And if you're going purely on sentiment, you'll definitely miss the move. But the short-term indicators will at least get you moving while you're waiting. If you wait till everybody's euphoric and cab drivers are giving stock picks, then it's done. You've already missed it. So moving averages really do work from a technical standpoint, because the thing is, this thing could go lower a lot sooner before it can go up.
So one more time on what you would be investing in right now. You're sticking with some of the higher yielding.
Yeah, I think on the fixed income side, that's where people have their powder dry. You don't have to stay with treasuries. Corporates are in real good shape, a lot of cash on the balance sheets, and foreign sovereign debt paying great yields right now.
What are you buying?
I'm still buying U.S. technologies, and I'm also liking high-yield munis right now. I think the lower-grade munis are going to give you great value. 2012, the risky bonds may be the safest bonds, and that's how we're playing it.
Very good. Good conversation, gentlemen. Good to see you both.
Thank
Thanks
you
for joining us today, Mark Lamkin and Tom Lydon. And Tom, I'll see you later on the countdown coming up, which is in about 23 minutes here.